break this into 3 sections. Let's break this into 3 sections. I'll go through my sections and then I'll pause and we'll ask questions then. And then we'll get through a couple of questions and I'll move on to the next piece. I want to make sure that everybody is going along because this is some intense information that I'm going to be bringing to everybody. So be prepared for overload.
Perfect. So if you have questions as he goes along, put them in the chat and we'll ask him when he takes his pause. It's all yours, Rob.
Well, thank you. First, I want to say thank you to Kathy for putting this together. This is awesome. As you can see, there's a lot of juggling that she does. And I appreciate it very much, Kathy, what you're doing. I'm new to the organization. I just joined a couple of weeks ago. I'm new to the area. I'll tell you that in a second as well. And I want to thank everybody for coming out tonight. Time is one of the most valuable commodities, and I'm very big on valuing time. So I appreciate everybody putting some time in tonight. And I promise that I'm going to deliver you some valuable information tonight about the down economy, about how to make money in the down economy. But I'm going to ask one favor. I'm an introvert. I get nervous when I'm on camera. I get nervous when I'm in front of people. So I'd love to see faces to know if I'm actually saying something wrong or if I'm losing somebody or if I'm insulting somebody. I'd love to see cameras on and see faces. Oh, here they are. They're all coming on. My screen is starting to light up. I want to see these faces.
Good
and I'd
job.
love
Thank you,
guys. If I'm doing okay. Okay, you guys got to support me with this. Okay, so I put a lot of time and effort into putting this together. I practice and practice and practice. I'm probably not going to say a damn thing that I practiced. Okay, so let's just go ahead with it anyway. And I'm going to be recording this so I can put it out on my website too. So forgive me if I sound a little bit like a robot here and there because I'm going to try and repurpose some of the video as well. So if we're ready to go, I'm ready to go with you guys. All right. So
we're ready. It's all yours.
All right, let's get started. If you want to go anywhere in life and you want to get there fast, you go alone. But if you want to go far in life, you got to go together with other people. And so my mission in real estate here is to serve others that want to get far in life with real estate. But I'm here to tell you that most of what you learn in real estate is not completely true. And tonight I'm going to show you what the rest of the truth is. So who should be listening to this now, in the future, whenever you're listening to this? If you're somebody that wants to make money without a greater purpose, you probably shouldn't be listening to this. Turn off the video now. If you're someone that wants to not be driven by a higher purpose, you probably should turn this off right now because you're not going to like what I'm going to have to say. And if you like to make money and use people doing it, I'm not going to ask you. I'm telling you, leave. Because I like to help people and use money doing so, where most people like to make money and use people to do so. That's not my philosophy. So who should be listening to this? I'm going to tell you who should be listening to this. Oh, we should be sharing my screen, actually. How about we share my screen so you can see what I see?
There we go. We got it.
Everybody can see that, right?
Yep.
So who should be listening to this with me? Who should be here? Those that have an innate sense to serve others. Because I'm going to tell you, everybody is looking at real estate and learning about real estate, not because they really care about real estate, but because we want to make money. We want to economically gain for ourselves personally. You know, when I often meet people, I meet a lot of people. I've been doing this for many, many, many years. And I like to get to know people. One of the questions that I love asking people as I get to know them, I ask the question, what do you want to be when you grow up? And it always throws people up. What do you mean? Some people, I get one of 3 answers. I'm growing up. What kind of crazy guy is this that he's asking these types of questions? And you turn off. Other people like, well, I want to make money in real estate. And that's, you know, the face answer. I like to go deep. We all want to make money. But for what purpose? Why do we want to make money? I'm going to tell you my reason. I love my children. I was given a second chance in life. And in my second chance, God blessed me to be the father and the steward of 2 beautiful children. And I promised God that I would do my best on this earth to raise them properly and to make a positive impact in life. But unfortunately, the world we're living in today is making it harder and harder and harder and harder for parents to do so because of money, because of what our leadership is doing, ripping us off with inflation, ripping us off with division, and doing all these things to beat us up inside of their fiefdom. And it creates a lot of distraction, and it creates a lot of challenges. So I started a mission of capturing tomorrow. I use my real estate business, making money, to capture tomorrow for my children. And we all here have the opportunity to do that. And so who should be listening to this today? Moms. Moms should be listening to this, who have the responsibility of taking care of their family too. I'm putting a special group together for moms because, unfortunately, guys, you're not going to like what I'm going to have to say, but I feel it's the truth, that women have this sense of protection and survival at the mama bears, that they will do whatever they will want to do. It doesn't matter what it is. They will do whatever they need to do to protect their children. And in the world we're going into with the economic headwinds that we're about to face, that's exactly the attitude that we need. You need to do whatever it takes to protect our children moving forward. Dads, I'm going to tell you something, what the responsibility is for being a dad. You, as a father, are your son's first hero and your daughter's first love. That's who we are. And we have the responsibility of guiding them with good values, with good systems, and with money. Because as we train them with money, the more that will be thrust upon them, the more abundance that will be thrust upon them. And then we get to where we want to get to, which is the reason why we all got into real estate in the first place, to get to that level of abundance. All of the teachings that you hear in real estate is about how to build up your real estate portfolio. I'm going to tell you that's the wrong thing. You don't want to build up your real estate portfolio. You want to build up your empire. Because when you build your empire, that's when you get above the influence. That's when you get above the control. That's when you get above all of these things where leadership, government want to take from us, control from us, and take our freedoms away. You want to rise above it all and get true freedom? You got to build an empire, and I'm going to show you how to do that. That's what capturing tomorrow is all about. Because we have a couple of headwinds today. We're about to go into an economic winter like we've never seen before. Okay? We're about to see the biggest financial crisis that we've seen in our lifetimes. Now, people get scared of that. I love that. And I'm going to tell you why. Because the greatest fortunes in this country and in the world, as a matter of fact, have been made in down economies. So the greatest wealth transfer that we are about to experience in our lifetimes is coming, and it's going to last for a couple of years. The challenge is there's very few people that are going to know about it, take advantage of it, and receive their share. I'm here to tell you that I'm going to show you the way how to get your piece. It starts with real estate, but it goes beyond that. And part of it goes with the education. See, traditionally, we're told by financial advisors, 97% of all financial planning says you got to go into stock, bonds, index funds, and everything in the public markets. And I'm going to tell you, that's a sucker's bet. That's a retail market. The way the game is really played is they put people in that retail market, so that's where all the losses can be sent, and they socialize the losses. Only 3% of all financial advisors will tell you what alternative assets are, how to hedge against loss, how to do things not just tax deferred, but tax free, and how to free yourself from liability. When you put those two pieces together, now you're building an empire. And real estate investing falls into that one shelf of alternative assets. And that's a whole world. And I'll dive into that one shelf in the little time that we have here together. But let me tell you how I got to this position knowing all this. You see, I've done over $1 billion in transactions of mortgage debt, whether I originated loans, traded loans, bought them, modified them, did due diligence on them. Let me tell you a little bit how I got there too. Before the Great Recession happened, I had my own mortgage bank back from 2001 and then 2006 and 7. I saw the writing on the wall that it was going to crash. And I was one of the hottest things going. I had money, driving around in a Porsche convertible. I was single at the time. I was lending money, my own personal money, doing all this stuff. And I thought I knew it all until the Great Recession came. And it turns out I sucked at all of it because I lost all of it. I was not prepared for what the outside forces had for me. And so I went into a bankruptcy. I went to a Chapter 13. And it was at that time that I actually went to law school to become a paralegal because I wanted to learn how the legal system worked because I was going to fight my way through my bankruptcy. And at that time, I started a litigation support company where I was helping attorneys defend illegal foreclosures because those big bad banksters were taking advantage of people. And so I had to go and help myself first. I got an attorney, I went to my bankruptcy, and I sued two of the biggest banks in the country, in the world actually, who had my mortgage. I sued them for illegal foreclosures, and I can't get into too much of the details because I'm bound by confidentiality, but the gist of it is I beat them both. Not only did I have one of the big banks pay all of my creditors off and my entire bankruptcy estate and pay my attorneys, there was actually money left over that I walked out of bankruptcy with a check, a nice big check. You'll never meet anybody that goes into bankruptcy at a certain net worth and comes out at a higher net worth. I'm that guy. And what I went through, the 3 years of litigation and fighting and this and that, I got into deep depths of how the banking system works and how they take advantage of people and how the debt works. And I was, from that moment on, I was determined to go and fight this system and do better than the banks are. And I found out that you can actually buy these notes. You can actually buy these mortgages from the banks, and then you become the bank. And I said, I love this game and I want in. And I've been doing that ever since. I started my own private fund in 2014. I started raising some money and I started buying all these mortgage notes. And now I'm the bank and I'm now the decision maker on keeping people in their homes. I foreclosed on one home so far in the 7 years that I've run my fund, and that home was vacant. That home was vacant. I've never put anybody out of their house. I've modified everybody. As a matter of fact, I have right now a loan in California who hasn't paid me for 6 years. But he's a veteran, and I will not foreclose on a veteran. It's a second mortgage that I have. He's paying his first, and I will not foreclose on a veteran. Because the beauty of this is, even though he's not paying me, I'm still making money because under the note, I'm still accruing interest. I may not be getting payments, but every month that the month goes by, that balance goes up and up and up and up and up. And at some point when he sells the property, they're going to ask me for a payoff, and that adds up. So I don't have to foreclose on them. So by owning the paper, it gives you so much more power. And that's what I call, well, not that I call it, but there's a concept out there called a FIRE economy, where you're owning financial instruments, insurance instruments, and real estate. And if you get into the FIRE economy, and you've started already with the real estate side, that's how you build a bulletproof empire that you can get through the upswings and even the downswings and actually profit off of the downswings. But let's get into this a little more. So more than real estate. Here's what you're taught traditionally in real estate. Okay, let's go own real estate. We start with wholesaling. Once we learn wholesaling and we get a couple of bucks in our pocket, we typically transfer over to doing fix and flip so that we can make more money. And then we typically want to get into the BRRRR, the BRRRR, where now we have some money, but now I want to make my money go to work for me, and I want to have the money work passively and gain some income. Okay, that's great. And that's where it stops. But that's not the whole game. So I positioned myself to help anybody in that position there to go and play offense by being the bank and getting to the next level. What does that mean? Give me 1 second here. So what do we have to look at? We have a couple of headwinds. I got to say this word the right way. It's a tough word. It is it's macroscopic cycles. It's a big word. Instead of microscopic, we have to look at macroscopic cycles. And what does that mean? It means, where are we in not only the real estate cycle, there is a real estate cycle. And I'm going to show that to you momentarily. Where are we in the real estate cycle? There is a debt cycle, long-term and short-term debt. Where are we in that cycle? There's a geopolitical cycle. Where are we in that cycle as well? And there are a number of other cycles that we go through. And knowing where we are in the cycles will help you to determine what is your best strategy in building your empire today. Because what's good today is not going to be the same that's good for you tomorrow. You have to constantly move in your investment career to move with the best assets, the best strategy at the right time. And I'm going to show you how you read those cycles. But that's our first headwind. We're going to go into a huge down cycle, and I'm going to help you to prepare for that. The second thing is we have a lot of misinformation, especially from the traditional financial advisors, as to what it is going on and how you're going to have to get through it. Traditional is not the way to do it. That used to be a way to make money, but that's not how you make money anymore. That way is over. Okay, buying up these distressed things is the way to go. So I'm going to show you the path. And so we're going to pause right here for questions about the environment and the macroscopic cycles before I move on, because the next two pieces I'm going to show you is how to play some offense and how to play defense within real estate using notes. But before I go on, is there any questions about cycles
Okay,
and the headwind
no
and the
questions.
environment we're going into?
No questions in the chat. Does anyone want to put a question at this point?
I have a question. Can you explain that last part again?
Which part was that?
The macro cycles?
Sure. And I'm going to do more of this in the end by defense, but I'll explain it to you again here. So there are no, so the reason why I brought that up is because of what caught me off guard in the Great Recession was stuff that I had no control over. The subprime crisis, meaning that there's stuff that goes on in our environment, in our investment world, that we have no control over. But unfortunately, we're still subjected to. For instance, anybody here have control over interest rates going up? No. Does that negatively affect our business? Yes. Does that stop us from making money in our business? Yes. And we have no control over it. So there are these outside forces that we have no control over that we still have to be mindful of. So if anybody knew that interest rates were going up a year ago, you'd be able to make different plays. I knew they were going up. I bought my last piece of real estate in November of 2021. I refinanced it in February of 22, and rates shot through the roof in March of 22. And everybody's, wow, that's great. You got the last thing. Yeah, it's like I just knew what was coming. I saw it coming, and I knew what to do and make my moves. And so these are the things that you have to look for. And so there's a number of layers. One of them being a real estate cycle, another one being a debt cycle, how debt goes up and down in interest rates and stuff, and then other geopolitical cycles as well. I don't have time to go into all of it here, but I wanted to make you aware of it, that there are outside forces that you need to be aware of as well. So when we get into the defensive piece that I'm going to talk about and the risks that are out there, how do we mitigate some of these risks? So I'm just identifying some of the things that are out there that we have no control over. Does that make sense?
Okay, there are no other questions in the chat. So if you want to move on to your next piece,
Great.
I think you're good.
Go on to playing some offense. All right, so we want to build an empire. This is the quote from Albert Einstein that changed my mind about the whole thing. Interest is the eighth wonder of the world. Those that understand it, earn it. Those that don't, pay it. Which side of that equation do you want to be on? The earning side, exactly right. So what I'm starting to show you is a pattern of there are two sides of this conversation. The traditional side, the alternative side. Things we can control, things we can't control. And now I'm showing you which side of interest do you want to be on. And I'm doing this to open up your mind because your mind has to be ready for this as well. So we talked about equity in real estate, wholesaling, fix and flip, and the BRRRR. Okay? From there, the next logical step is to be a private lender. But wait, that's the banking side. And be, oops, I want to go there. And then owning mortgage notes as well. And that's how you get to the next level of being offensive, where your money goes to work for you. The reason why you want to buy notes and do private lending is so that the money goes to work, not you. The idea of this is there's an idea of leverage. There's a whole, I mean, that's a whole module I can do on leverage, but Leveraging time, not only your time and other people's time, but leveraging the time of your money. If your money can go to work, that gives you more time to go collect more money, put more money to work. And the way you do it is through debt. Here's one thing I want you to understand it all as well. Look what it says on the top there. Own nothing and control everything. The way to build your empire and the way banks do it is by owning nothing and controlling everything. What does that mean? Let's take an example. You own a multifamily, 4-unit multifamily. And in the 4-unit multifamily, you're getting income on 4 units. Let's say you're getting $1,000 for each unit. You're getting $4,000 a month in income, and you have to go get a mortgage, a bank to come and give you a mortgage as well. And that payment monthly is $3,000 a month. It's a typical way they teach you. You get $3,000 a month of outgoing money and $4,000 a month coming in. You're positively cash flowing $1,000 a month, and that's great. You have now become a real estate expert and guru. Wonderful. But what happens if 2 of the units go vacant and you don't have that income? That money has got to come out of your pocket to pay the bank. The bank doesn't care that those units went bad. The bank wants its $3,000. What happens if a storm comes through and drops the tree on top of the house and you have repairs and expenses? The bank doesn't care. The bank wants to get paid $3,000. And this was a new one. What happens when a pandemic hits and the government says, well, the tenants don't have to pay rent because they can't go to work? The bank said, we don't care. We still want to get paid. So is it better to be the money partner in this deal, or is it better to be the landowner in this deal? See, the banks control everything, but own none of it. Because if the landlord doesn't pay the bank, then what does the bank do? He'll take the property, take it back through the process of foreclosure, and then go find somebody else to sell it to. So the bank has all of the power and doesn't own any of it. So I want you to open up your mind to this, that we want to move over from being that landlord to owning the notes and owning the debt. Whether through private lending, when you start lending your own money or other people's money, or through buying the notes. So it's very similar in concept to owning real estate. Let's look at the comparison between the two. Is it a hard asset? No. The house is, the ownership of the house is represented by a deed, and the note is actually the promissory note, which is a contract between the owner of the property and the lender. It's a promise to pay. It's just a contract. And the property becomes the collateral in case that promise to pay defaults. If that person doesn't make payments, then the bank has recourse to go get the property. So it's 2 separate things. Is it financeable? The house is financeable conventionally, but there are unconventional methods to finance loans as well. Liquidity, yes, there's primary and secondary market liquidity. You can go out to the primary markets and get financing, secondary market with investors for loans. There's a whole bunch of money out there that'll help you buy loans and lend you on loans as well. The overhead, very high overhead on owning a property maintenance, paying the taxes, taking care of, if the water heater goes bad and all this other stuff that goes on, insurance. You don't have all that with owning a loan. It takes, on a performing loan, my monthly cost to service my loan is $30 a month. $30 a month. And I do nothing. I don't send any of the payments. I don't send any of the accounting. I don't do any of the payoffs. I don't do any of the foreclosure. I don't do any of that. It costs me $30 a month. So that's the very, very low overhead. There's more risk in owning the property than there is in owning the loan. Because as you own the loan, you're considered the bank. And let's face it, the banks get away with everything today. Banks and insurance companies run the world. They literally do. And so when you get on the other side of the equation, become the bank, you are now like them, and you will be not targeted for taxes. You will not be targeted for regulation. You will not be targeted for any of this stuff as landlords. Going into the velocity of money is another concept. It's inefficient in turning money on real estate. I mean, it can be, cannot be. It depends on which strategy you're using, but it's very efficient on money. Due diligence on the property, whether you're doing title reports, and especially doing fix and flip, you got to do your scope of work, your rehab budget, and all this. There's a lot of due diligence you need to do, but it's very low on buying and trading a paper. Is it insurable? The property is very insurable. It's hard to insure a loan, but we solved that problem internally here, and I'll show you how we did that. And then third-party management is optional, but it is required on the side of the loan. So owning the paper is not that much different from owning the property. There's 3 reasons why you want to own a piece of property: because you want to build wealth and capture the appreciation, or you want to gain cash flow on a monthly basis, or you want to try and wholesale it and make some transactional fees. You can do the same thing with the paper. You can trade the paper, you can hold on to it and get interest payments every month. But the beauty of why, one of the main reasons why I love owning mortgages versus real estate is, let's talk about that appreciation piece. Paper and the mortgages don't appreciate. But let's talk about that for 1 second. I want to dive, this is a very important point. Appreciation is a growth strategy. I buy it at a certain value, and then I sell at another value, and I capture all of this gain. When you're buying a note, you still have that spread. It just works a little differently. Here's a $500,000 note, but I buy it at $250,000. So you're buying it at a discount. So you're creating that spread because of the discount that you're buying it for. And so my appreciation of my gain is automatically captured because I know what I'm buying it for at whatever discount. All right, so let's stop there for a second and see if anybody has any questions. I know I'm going.
There's none in the chat, but Daryl has his hand up. Daryl, did you want to unmute and ask a question?
Yes, good evening, Rob. Thanks for sharing.
My pleasure,
In
Daryl.
reference to the insurability, does PMI or MIP comes into play as far as if the lender forecloses, they step in to pay a premium for the owner of the loan?
That's a great question. It's a great question. They do for the institutions. They don't for us.
So therefore, if I buy a note that's been covered by one of those entities, that privilege doesn't pass on to me from the no bias aspect if I go to foreclose?
Correct, and I'll tell you why. There are a lot of big hedge funds and institutions in this game. They're buying these loans from each other at billions of dollars at a time. If they're going to go and foreclose and claim that loss and hit the insurance, they're going to do it all themselves. By the time you get that note, it's already been through the insurance claim, and then you're going to get it from another one of those. You're moving down the food chain. So let's say, a BlackRock buys $1 billion worth of stuff from Bank of America, and some of these stuff are FHA guaranteed by the VA, and they have the
Fannie Mae,
PMI on
Freddie
it.
Mac.
Exactly. They're gonna run through it, shave off all those insurance claims there, and then they'll say, you know what, we don't want stuff anymore. Let's just trade it out to middle markets, and we'll trade it out. But that's okay, because at that point, you're pricing that in. So if it's, let's say, a $300,000 loan and it was 100% LTV, and they already collected on the insurance, and you're not going to have the benefit of the insurance, you're just going to negotiate the price back down to, I'm not buying at 60 cents, I'm buying that at 50 cents because you already chewed the meat off of that bone, and I can't have that, so it's not worth as much. So you go into the price, and you just
So you discount your offer, right?
Okay. Yeah. So you price it in, and all you're doing when you're pricing these things is you're pricing risk. Well, I don't have that coverage in the insurance, so I can't be paying 100 cents on the dollar. It has to be discounted even more for that. So no, you won't get it directly, but you can use that in negotiating your price. And so you'll make your money in your negotiated price up front when you close. That's a great question.
Thank you, sir.
Yep.
Thank you.
Does that answer that question?
Yes, sir, you did.
There is a question in the chat now, and then we'll go to Stephanie, who has her hand up. The question is from Keith, and is, what is the typical size of mortgage an individual can buy?
Oh, there's no limit. So that's up to you.
How much money you got?
Exactly. Depends on, and that goes into that's a loaded question, Keith. It's a loaded question. You look, you have $5 million. Would I tell you to go put into one loan? Absolutely not. I would suggest this is unsolicited advice, and it's only worth what you ever pay for it, so it's worth nothing. Okay, so I would suggest I like going between $150,000 and $300,000 because that's where the middle America loans are. Back up a second. I like to go where I know I can keep people in homes, and I can only keep people in homes. The only thing I can't bring to the table when I'm modifying loans is the income. I can't give them their income. So I like to go where people have jobs, where they have an income, so I can modify their loan into payments they can afford, and then moving forward, they have a job and they can afford that payment. So would I go and take $5 million and buy, a loan out in the hands as a second home? No way. Absolutely not. No, I wouldn't do that because I'm gonna end up foreclosing on that. Sure, I'd get a $6 or $7 million property, but then that market's drying up right now. So I'm gonna have to hold on to it for 10 years for the market to turn, and somebody likes the Hamptons again, and then who knows what the market. That's not me. So it's a loaded question. That comes back down to strategy and how you want to deploy your capital and how you want to maximize the yield out of there. So there is no limit on how much of a loan you can buy. It's out there, and
Nor
negotiate
really
the price, anybody can buy it.
nor really any minimum, right? It's just up to you.
Correct.
Okay.
It's up
All
to
right,
you.
Stephanie, what's your question?
You talked about that spread or that discount.
Yep.
Am I assuming you're talking about like non-performing note? And if so, what about the risk?
I'm going to get to risks in the next section. Great question. You were the attorney, weren't you? You asked about risk. You must be the
No,
attorney.
it was not her.
Oh, okay. Attorneys always ask about risk because attorneys are risk averse.
Well,
but
no, I'm a nurse, so I come at from that point.
And
of
I'm
There
an
you go.
attorney, and I'm not risk averse, so you never
there
know.
you go. So you're more of a business person that has a law degree than Kathy. That's the way I classify you.
That's
I have
true.
a couple of friends like that they don't look at it that way. Like, no, then you're in business and you're an investor. Just happen to know the law. Okay, so the question was, we're buying things at a discount means that we're buying stuff that are non-performing, and that's absolutely right. When we're buying these assets, we're pricing them based on the risk. If the risk is that the people don't have an ability to pay the current payment, then we're going to be buying that at a discount. Number of other factors that go into play here. What's the loan to value? Do they actually have a job? There's usually four main reasons why people can't pay their loans: loss of job, loss of household income, a divorce, a death, are the main four reasons why. So when you find out what's going on and how you can get to them paying again, that's part of the workout process. But all of that gets calculated into what your pricing is going to be. I hope that answers the question. Did I answer that question? You could say no. Sometimes I just talk myself around and confuse myself too. So did I do that?
No, I understand. Thank you.
All right, that's I guess that's it for this segment. Rob,
How
so
am I doing on time, by the way?
you're doing great.
How much time do we have left?
36 minutes.
Okay, good. So let's go, and I'm going to go back and do a couple of these as well. This is my last piece. Okay, so that was how to play offense. Let's talk about defense. This is one of my favorite things to talk about, playing defense in real estate. It's a very important thing. So far, let's recap. I talked to you about why we should be capturing tomorrow is for the benefit of the ones that we love. I talked to you about why we should be getting into mortgage notes, because that's how you're going to be playing offense, and that's how you super accelerate building your empire. And now let's talk about some defense, because unfortunately, the more money we make, the more that people are going to want to take it from us. The more that government's going to want to tax us, the more that people are going to want to sue us. Because unfortunately, people are lazy out there, and when they see someone's got money, they're going to try and come after you in the easiest way possible. So I call that a success tax. So the more money you're building up, your success tax is going to be fighting off everybody else who wants a piece, whether it be lawsuits, IRS. Can I give you guys my formula? I didn't put it in this presentation, but you mind if I give you my formula, where I'm coming with my thoughts? Let's write this down a second. I'm going to stop sharing my screen. I'm going to switch screens for a second. I want you guys to write this down. Let's stop sharing this. I'm going to just do this on the fly, if that's all right. Let's stop this a second, because I think this will help. Because what I'm talking about, I'm going to type this up as we do. I'm going to make big letters. This is what everybody should be writing down. Whether you're new at this, not new at this, or whatever, this is your wealth building formula. Okay, let's make it a little smaller. Let's share this screen here. I'm doing it on the fly. I got time, so let's do it. Why not? All right. It's not DFG. You guys can see that though? Oh, wait. There you go. You
Yeah,
can see
we can
DFG,
see it.
right?
Yeah.
Yeah.
Can see.
Here's what the formula. Wealth is equal to M times T times U times V. Oh, I got to put that in parentheses. Oops. Okay, so we got to make this to the H power. I don't know how to make it to the power. Minus L squared. Oops, make that now. Squared. So let's say we make this small, blah, 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 blah. I don't know how to make it up top. But you get the idea. Write that down. That's L squared and H to the whole thing. And I'm going to tell you what this is real quick. And so what I'm talking about right now, this L2 is to subtract all your liability. This is where you make your money. You build wealth by making the money in here. You wrap it inside of a hedge. And I'm going to go through in a second. You wrap it all inside of a hedge. And then you escape all of your liability. When you can separate, and this is what banks are very good at, when they can take their profit on one side and escape and extract all the liability elsewhere, they make total profitability, and then they take all their liability and they throw it on somebody else's balance sheet. They're very good at that. Okay, and I'll show you how that gets done in a second. But what I'm talking about here, about that wealth tax that people are going to come after you, this is where you want to get rid of this liability. And there's two main liabilities you want to get rid of: lawsuits and taxes. Those are the two main liabilities you want to get rid of. Now, there's plenty of attorneys out there that'll tell you how to go and do LLCs, right? You're minimizing your liability, putting all your assets in different LLCs so that you firewall between your LLCs. There are people out there that are using self-directed IRAs, solo 401ks. I was, in my early career, I was a big fan of LLCs. I moved on to doing things inside of trusts. I do a lot of things inside of trusts right now. I was doing stuff inside of self-directed IRAs. Then I found out some issues with it, and I went to the solo 401ks, and I was okay with that until I went to the trusts. And the latest thing that I found, which is phenomenal, is doing a lot of this inside of a whole life insurance policy. But that gets way beyond this, but it's very advanced. But you can do all of this inside of a whole life insurance policy. So this goes for estate planning as well. So that if you're doing, let's say, for your kids, that upon your death, if you build your life insurance policy with your empire and you build it into millions and millions of dollars, and upon your death benefit gets built into all that, when you pass, that death benefit gets passed to your children, it passes tax-free. Doesn't matter how big it is. So if you can live your life building your wealth inside of a whole life policy and build that death benefit, it passes tax-free. I love that concept. I'm working on getting mine set up and doing it but that's what we're talking about here. There are so many different ways that you can protect the money and the wealth that you create. And the two things you got to worry about is taxes and liability. That's the minus L squared. Okay, so you make your money in the M times X times U times V, and I'll tell you that in a second. And that's how you build your wealth. You wrap it inside of a hedge, and then you minus the liability, separate it out. Okay. I was told I shouldn't be saying this and give away some of my best secrets, but you know what? I don't care. I just feel compelled to tell you guys this because of where I'm going with this, and I want you to follow me. So there it is. That's my closest health secret, is the formula that I use, and there's my discipline. And I'm going to show you the hedge in a second. So let's go through this just real quick. M is money. It can be your money, other people's money, institutional money. Very simple, right? You guys already been taught that, how to go and buy real estate with money or with other people's money or credit and all sorts of stuff. That's what that is there. I really like, I'm gonna switch this. I like the utility next. Let's do this. I'm gonna switch it. Okay, because it's more logical for me to do it this way. M times U times T. U is utility. Where are you putting your money to work? Are you putting it to work inside of real estate? Are you putting it to work inside of notes? Are you putting it to work inside of crypto? Are you putting it to work inside the stock market? Are you putting it to work inside of funding an independent film? Are you putting it to work inside of your friend's business? Are you opening up a new business with your children? What's the money going to work for? Right? So what's the utility of the money? You take the money, what's its use? Okay, that's important to figure out where the money is going to work. Okay, times T. You got to have time frames set up. I have multiple time frames set up. I have short-term money working, I have mid-term money working, and then I have long-term money working. So let's go back to the basics of wholesaling. What's the time frame in wholesaling? Hopefully a week, hopefully 30 days, hopefully 60 days. We can turn our money and make our money within that kind of time frame. You won't survive just doing wholesaling. You got to get midterm money turns and then long term. That's where your money goes to work for itself long term. You got to build up to that if you're not there yet. So that's the time. And then the velocity of money. So let's say I'm putting my money to work. I'm going to take, let's say I don't know, I come up with a scenario. I've got a lump sum of money. I want to put it to work. I want to try funding independent films, and I'm going to put that money to work for 5 years. Okay, great. So how do I have my plan? 5 years, this money is going to go to work for that. How many times do I want to turn my money? Well, let's say for every 12 months I want it to turn, which means I'm going to have to do 5 films each 12 months. And that's the velocity of money. How many times are you going to turn it so that it can go out into the world, make money, and come back? Okay. But these are, listen, I know this, some of this stuff is more advanced and it's hard to grasp some of this. I'm doing this for the sake of saying it. Okay. And so that H goes to what I got burned by during the Great Recession is those outside forces that have no control over. How do you hedge over the things that you have no control over? How do you hedge against that? And that's a whole lesson in and of itself. But let's go back to my presentation here. Let's start this up again. And I wanted you to see that for where I'm going into with playing defense here, because the defense piece is about the minus L squared and the hedge. This is what I'm talking about now, okay? What I showed you inside of the parentheses is the offensive side, how you make money. This is the defensive side now, okay? So I'm going to get into this here. I totally went off script, but that's okay. So these last, okay, so let's look at this. Wholesaling, fix and flip, and the buy, rehab, rent, refi, repeat. I always think of that as cold. So then you get into the private lending and the note side. That's where you're playing your offense. Okay, here comes your defense. What I do is insurance and gold. I'll tell you why I do that. And that's the reason why I wanted to show you that first. My H is insurance and gold. Here's what I do. When I got into notes, I love notes. I love doing it. In my opinion, so much better than real estate. And I can send you guys these presentations. I see a couple people taking pictures of it. You guys can totally have this. Okay, this is all for you. I'll give you, I found a nice picture of the orange. If you don't want the orange, then I'll just send it to you. Easy enough. Insurance. So when I started doing the notes, one of the things that I found, going back to, remember this? Right here. Remember this piece? Insurable, that the real estate is easily insurable, but the notes are not. That was the only thing that ever bothered me. So what I found out when I went into my bankruptcy and how the bank set all this up and I got into the belly of the beast and how they did it, they always insured their deals. And I said, well, for us out here in real estate, buying the notes, nobody insures our deals. We got to find something to insure our deal so that when a deal goes bad, how can I still protect my money, my investment, my upside? So here's what I found. Abandoned life insurance policies is a big business. People who can't afford to pay their life insurance policy premiums anymore, we buy them. People, they use life insurance policies for estate planning. Once it's not used anymore, it gets abandoned. Business owners, key man policies, all these life insurance policies that have outlived their use, their practical use, get sold on a secondary market. So instead of the insurance companies picking up all these premiums and never having to pay out a benefit, there's an entire industry that goes and pick up these insurance policies, continues to pay the premiums, and when the policy matures, they get a lump sum payout. And I said, wow, this would work wonderful with what we're doing with our other fund on the note side. So that any mistakes that I make or any deal that I get into or any environment that I get into that I have no control over, if I have these policies that upon maturity just fill my bank account, well, it doesn't matter how much I screw up then. I'm getting paid. And so I found the way to take some of the risk in my business and offload it onto these policies. And now in that, just like in that equation, I've separated the two. I've wrapped it inside of a hedge so that my money times utility times velocity, when I screw it up, will automatically be covered by a life policy that I have attached to it. All I got to take care of then is the minus L squared. I use the gold as a currency hedge. So that goes to our inflation issue and our leaders and our governments and all the greed that we have out there in our government wanting to print all of this money. I can go into all of that about how inflation works and all this stuff, but the benefactor of inflation is gold. Gold prices go up. So I built my business from wholesaling to fix and flip to the multifamily, went into private lending, bought notes, started doing insurance, and my extra money that I have in my private bank, I do as gold as my private reserves. And that's how you get to bulletproofing your empire. And so now that we go into a down economy, these items, the private lending, the notes, the insurance, and the gold, become a plethora of opportunity. This is where you buy these distressed assets, build your own portfolio, and then it just pop, starts paying you. This is what the FIRE economy is. Owning the financial piece, owning insurance pieces, and owning the real estate. And that's how you build the empire. These are how banks and insurance companies do it using private notes. You start with the real estate, but you want to graduate into the private lending, the notes, and the insurance, and the currency hedge. That's the game plan. That's where you want to go with this. So I'm a big hockey fan. Wayne Gretzky, greatest hockey player that ever played the game. Love this quote from him. He was he's the highest. He holds the record for the most goals ever scored in the professional National Hockey League. And he always said that the only reason why I was a good player was because I always knew where the puck was going to be. And as he says there, a good player is where the puck is, but a great player knows where the puck is going to be. So as real estate investors, as the stewards of our children, as the stewards of their future, we don't want to be good. We have to be great. And so you need to know where the environment is going, where the markets are going, to get ahead and also to prosper before anybody else does. So I'm going to get into a couple of cycles here. But before I get into it, I think I have a little more time. I could spend a ton of time on this. So let me check on time and questions and how we're doing. So I know if I'm going to go through this last piece rushing through it, or if I can take my time and kind of just play with it.
You have 20
so how
minutes.
are we doing?
You have 20
Sorry?
minutes. So I think you're
20?
good. You want these questions before you go on?
Yeah, I'm sorry. Did you say 20 minutes still?
20 minutes.
Oh, this is great. Good. Okay, so let's do some questions and then
Okay,
we'll go into
so
the
we have 2 questions in the chat and 1 person with their hand up. So the first question from Isabel is, for the life insurance, do they mature upon the insured's death? And also, which markets are abandoned policies sold?
Great. Yeah. So the answer to the first question is yes, that the original insured, once they have a maturity of life, that's when the payment goes out. The difference is So the way that works is we will pay for the ownership of that policy. And so we become the owner and the beneficiary. So upon the maturity of that policy, the maturity of that life, we're the ones that get paid because we were the ones continuing to pay the premiums over the course of life. And there is a secondary market out there. It's just relationship building. You know, there are hedge funds out there, other providers out there that trade this stuff. As a matter of fact, there's a lot of law behind this, that especially for the consumers, where when a consumer cannot afford to make premium payments anymore, the insurance companies are required by law to send them a notice to notify them that there is another option for them, that they have the ability to sell their policy as opposed to getting nothing for it. They do have the ability to sell their policy, and they usually name industry participants where they can go to and call and see if they can sell their policy. So even the regulators push that marketplace so that the consumers itself don't get nothing for it. They can get something for it. So we're providing a service to the consumers and the attorneys that are doing life planning or estate planning stuff. So it's definitely a good service we provide, and it's profitable for us and how we retool it and reuse it in our business.
So David's asking if there are courses, books, classes, websites, conferences that you recommend.
For which?
I'm assuming the life insurance part.
Yeah, there's no classes on this stuff. This is not that I know of anyway.
Well, looks like, so we need someone to develop one, Rob,
Yeah.
And for the notes as well.
I'm sorry. And for the notes?
for the
Yeah,
notes.
and for the notes.
Well,
said that?
we just
I got to
had
see who
one-
said that first.
we
I want to
just
see
had
faces.
one
Who said that?
last Saturday. Did y'all go to the one we had last Saturday on Zoom?
Oh, yeah, we went and it was great. Of course, it left us with more questions,
Of
which is
course.
why I'm sitting here going, yeah, I'd like to get to know a little bit more. In fact, I wanted to know about seconds, partials, value adds to notes. So it's all stuff that got churning around in our minds, and been sitting here waiting for the right time to ask it. And so anyway, there it
Great.
is.
So I have extra time. I can talk about all that stuff. So when I
Okay.
finish up here,
All right, we'll
whatever
save
extra
that.
time that I
We'll-
have,
Okay,
we'll save
I'll
definitely
put
can
the
go
rest,
through it.
I'll put the rest of my
But I'm gonna
questions
say-
in the chat.
Okay.
But yeah, but I'm going to say this,
Um,
that there's so much information here. You can't do it in just one sitting in one course. This has got to get done over the course of time. This has got to get done in layers. It's not here, I'll teach you how to do it and it's done. No, this is, it takes time to it's an attrition, that's why I said in the beginning, I tried focusing. You got to be doing this for a reason beyond yourself. You
Yeah,
have to, because
and
this will get daunting.
And I think the seconds, partials, and value add is probably one of those layers that we won't get to tonight, but we'll save the recommendations to the end. Okay, I have two more questions and one person with their hand up. How do we educate ourselves on market cycles and their respective phases so we can see things before they happen?
Stay tuned for the next 30 seconds and you'll get educated on that.
Okay. Do you get tax advantages for holding notes? If not, how would you suggest still doing real estate investments if you're a W-2 employee?
My husband would actually handle that, and he's not available right now.
I think somebody's on a call with a microphone on.
Is this-
maybe by
the-
tomorrow around this
You
time?
mute everybody?
Whoever's yeah, they're supposed to stay muted. Hold on, I'll figure it out. Whoever's talking on the phone, please mute yourself. Okay, sorry. Do you get tax advantages for holding notes? If not, would you suggest still doing real estate investments if you're a W-2 employee?
Okay, so I have to give the standard disclaimer. I am not a tax advisor. Please consult your tax consultant on that. So I can't give any tax advice. But the answer is no. You get no tax advantages.
I
No, you
think
have to
they're
do that.
probably referring to the fact that if you own rentals, you get all that sweet depreciation.
Correct.
Yeah.
Correct. You get the depreciation. Yes, that's one thing you do lose on the note side. But that's why I say if you do this, let's say inside of a self-directed IRA, inside of a whole life policy, there are other ways to do this. Or one of the things that I do is you can create losses too. I'll give you a perfect example. So if I buy a loan, let's say I pay, and I'm making numbers up, just for the sake of making this example. Let's say I bought $100,000 loan and I bought it at 40 cents on the dollar for $40,000. In order to make a deal work, and I've done this before, I've had people that are resistant. I don't want to pay the loan. I can reform the loan to get them to a payment, and then they have some resistance. And so I put this in front of people and I say to them, look, if you sign your modification agreement and start making payments within the next 30 days, I will knock off 15% of what you owe me. Right? So let's think about this. If it's $100,000 loan and I knock off $15,000, and so now they're going to give me a new loan at $85,000. And let's say, again, it cost me $5,000 to get there. I literally have doubled my money because I gave them incentive to close right away. And on paper, I've taken a $15,000 loss. On paper, I've taken a $15,000. I've created my losses and doubled my money. I know that's, follow that for a second. I've taken an asset I was entitled to $100,000. I've forgiven. Now, the bad side of that is that the homeowner is going to get a 1099 for $15,000 for forgiveness of debt. But I'm not sure if that is still, there was a hiatus on that phantom income to consumers. I'm not sure if that's still going on.
I think it might have expired. I'm not 100% sure.
I'm sure in this next downturn, they're going to reinstate that again, where we do this forgiveness of debt. They're not going to tax the consumer again. That will incentivize us to give more deals like that so that we can get the people staying in homes and get them to redo it again. But I'm not sure if that's on or off. But I created a loss and given a forgiveness of debt. So there are ways to do it.
Okay, Raghunath has his hand raised, and then we have one more question in the chat, and then we'll let you move on. Raghunath?
Hey,
Hope I'm
Kathy.
saying that
Hey,
right.
hey, you can call me Raghu, Kathy. So,
Raghu, okay, good.
Rob, one question. Thanks for the great lecture and presentation. In a typical investing scenario, would you be doing, let's say, would you be looking out for, let's say, I make an offensive investment? Would you also be to offset that? Would you also be doing a hedge on the defensive side, or you just, you do it cumulatively as you get opportunities?
It depends. It depends on what offers and stuff. So I'm always looking at that formula to execute. If the hedge is there, I'll do it. So the way I've solved that, though, I've started a second fund buying life settlements. So I have in that second fund a plethora of life settlements that go to me. So I've built up my hedge side, way more of a hedge than I have on the investing side now. So I can just go ahead and take more and more and more risk because I've already built up that hedge because I've created some partnerships and have done that inside of a fund. But you do it as you can. But I didn't want to run into that problem of trying to balance it all out. So I said, let's just do a whole fund, put a bunch of life settlements in there, and we got it there on the shelf to offset anything that we're doing. We don't have to worry about it anymore with all the note investing that we're doing.
Sure. Last question. Do you take other people's money, or you just invest with your own money?
We take some other people's money, people that qualify. We've done that. We do that, but for qualified people, we do.
Sure.
And you'll have your contact at the end, I assume.
Yep.
Okay. There are now 2 questions in chat. I'm going to tell y'all this. After he answers these questions and he'll go on to finish up, if y'all want to make sure and scroll through the chat, I know there's some wholesalers trying to connect with people who are looking for them and some mowing. So y'all want to scroll through the chat and make sure you have all that info so that when he finishes up, we'll be ending. Okay, so first of all, Keith is asking, are there specialized companies that can do the workout to help you evaluate the quality of the notes?
Yes. I'm going to leave it quick like that because I want to move on. But yes,
Okay.
there's attorneys, servicers, all sorts of vendors out there that support this business. Absolutely.
Okay, Maggie is asking, how do you actually buy the note? Who do you call? Where do you invest the money? Is there a notes MLS or some, market where you can shop? Is there a broker? I'm really interested in how to actually do that.
Yes, there are some note marketplaces out there. What I would say though is there are industry events. I'm not gonna on camera here promote any one particular industry events, but if you look up note conferences, you'll come up with a couple. I'm speaking at one on the 23rd down in Orlando. And networking. It's a matter of making relationships, networking. It's a well-established industry, and it's just like being in real estate. It's networking, finding the events, finding the people, hanging out, making relationships. People do business with people that they like. Get to know people. It's all a people business. It's all a people business.
Okay, you are free to finish up. That's all the questions.
Perfect, because I'm going to finish up with real estate cycle and then a big macro picture, but it's so open-ended that we can just finish it off however you guys want to finish it off. So this is a perfect ending. Okay, so in my 20-something years of doing this, I want to say it this way so I can record this well. In my 20-something years of doing real estate investing and investing in distressed assets, the number one reason why people get into trouble with their investments is because it's a mismatch between their capital appetite and the strategy in which they deploy their capital. And that goes down to the core of missing the market cycle. So you must, in order to succeed in this business, you must have the right strategy within the right part of the cycle. I'm about to show you the cycle and what you should be doing in each part of the cycle. Let's go. Click, click, click. Let's get this to work. My screen is shared. Is that correct? You guys can see it?
Yep, that is correct.
Perfect. The real estate market cycle. No, whoa. Why are we going backwards? Oh, forward. Here we go. Real estate market cycle. I have gremlins here. Okay. There's 4 phases. I'm going to start at phase 1. It's weird the way this was set up, but phase 1, and I put it at the bottom because that's really the bottom of a cycle. We sometimes talk about the bottom of the market. Okay. That's the colloquial term, is the bottom of the market. I put it at the bottom of the cycle. That's when things start to recover. When things bottom out, right after they bottom out, they start to recover. So let's talk about phase 1 in a recovery. So from phase 1 going into phase 2, that's when you want to start acquiring rental properties and fix and flip. If you feel that we're in a market that's recovering right now, that's what you should be doing. Phase 2 is the expansion phase. That's when people are prospering, people are making money, economies are doing well, and that's when I believe people should be lending on the fix and flip properties, lending on multifamilies. Now, here's the main reason why. Did you ever hear the statement or the adage that, once the guy that's shining my shoes gives me stock tips, I know it's time to get out? Right? It means that everybody is in the business. And when everybody's in the business, the smart money leaves because there's too much dumb money in the business. So when everything's expanding and everybody's making money, that's when the dumb money comes into real estate. That's when you need to get out and start lending to those people. Okay? Then you get into the hyper supply. Now, I love this part. Let me say this. I'm going to do this in general terms, and then I want to tell you that everything I'm putting on the screen here is not exactly true. So just bear with me a second for the people that are going to doubt what I'm about to do. I'm going to call out my own BS in a second. Hyper supply. You get to the hyper supply piece. And when you get to the hyper supply, and again, you can write this down, but I have no problem sending this to you, to all of you as well, to have this. That's when you want to do gap funding on fix and flip. What is gap funding? I've done a lot of gap funding. That's when those that want to do fix and flip, they got to get, you're going to get a 75 or 65 loan to cost, and you got to come up with the other 25 or 35% of your own money. You got to find a partner to come into that. That's the gap piece, that equity piece. I've lent on that. That's a great business, actually. If you're underwriting it the right way, I've made a ton of money doing gap funding on that. I've had a bunch of people who have not finished the projects, and I've captured all the upside. It's a very good business, actually. And then you get into the recession phase. From the recession phase, once we go into reception, that's when you want to get into the multifamily value add and the NPLs. So let me say this. Depending on what market you're in, you know the old saying too, that real estate is local, every market is different. Depending on what market you're in, you're going to be at a different part of the cycle. So depending on what, because I invest nationwide. So when I look at the different markets, I'm going to say that this market is in a different part of the cycle. I'm going to do a different strategy and this strategy and that strategy. So I do different strategies based on this, depending on where we are in the market, because every market is a little bit different. I personally like to look for jobs and job growth, because as I said before, the one thing I can't give people in order for me to create my wealth, I can't give them the income. So if they have a job where they can go out and go to work and come home and make that a payment, that's where I'm going. I like looking for jobs because that'll give me the cash flow. Now, there are certain places where I can see certain economic growth coming, that I may just go for growth and buy, stuff longer term because of where it is. So those are the 4 phases. That's where you want to be. I'm going to give you another cycle. Not so much a cycle, but I'm going to give you another, I don't want to say it's a formula, but let's just go into it, okay? These are 4 considerations that you want to do with any type of investing. And I said this before, macroscopic cycles. And in our business, it's going to be that real estate cycle that I just showed you. You want to consider. Debt cycles has to do with money and the cost of money. Imperial cycles, which is a little more advanced. This is where the world powers are going and world reserve currencies and the currency wars and all that stuff going on. It's big picture there on how the central banks and are doing all that. That has to go with the wars in Ukraine and gets bigger picture. But you want to look at all this stuff because all that ties into where a lot of this is going to go. It trickles down to us, and we're all, lower on the food chain there, but it does affect all of us. But you want to look at this stuff. Once you look at those macroscopic cycles, you want to have geographic diversification, which means, as I said before, there are different markets. Different markets are going to do different things. If you don't have the ability to be in different markets, then you apply that real estate cycle to the market that you're in. But if you have some geographic diversification, I invest nationwide in different places, not everywhere, but I look for, as I said, I look for places that has job growth. So, I mean, you have a lot. One thing that's going on now that we had never had before is all this migration that's going on. Okay, I'm living proof of it. I came from the Northeast. I came from New Jersey down to Charlotte. I wanted to save my kids because of what the schools in New Jersey are doing to the kids and how they're indoctrinating them. And I wanted to save my kids and their future. So I wanted to get them to better schools, better places. I came down here. Not only did I find better schools and better living, I found the nicest people down here. I couldn't be happier being down here. They're just generally nice and happy people down here. I love it. So we're going to be doing a lot in the community. So geographic diversification. And by the way, my personal opinion here for Charlotte, I think we'll go through a little bit of a downturn because everybody's going to have a downturn, but I don't think the downturn is going to hit as hard here in Charlotte from the real estate side. And I think we'll have a faster rebound here simply because of the demand of people that are coming here. It's that simple. There are jobs here. We have a government here, a local and a state government that's investor friendly, business friendly. It's family friendly. That's what people are looking for out there now. People are searching for this. So you're going to have a lot of, I know the Yankees are coming. I'm one of those Yankees that came, and there's going to be a lot of more of them coming from all over the place. But that's good as investors. That's good as investors that we're going to be there to help them to get housing. So geographic diversification is important. Asset class allocation, meaning that goes back to that you in my formula. What are we putting our money into? Depending on where we are in the cycle, do you want to put your money into notes? Do you want to do private lending? Do you want to do the fix and flip? Do you want to do multifamily? So that's your consideration as well. And then the last one is isolating the risk. That's that L squared that I said too as well. Those are the four things when you're looking at an investment, whether it be traditional, non-traditional, those are the four things you want to look at. And I showed you in the first one what the real estate cycle looks at. That's it for me. I'm going to put my information up here. Oh, that's how you create your bulletproof empire. I'm putting my information up here. That's how you can get in touch with me. And I am yours for whatever time we have left to answer any questions that you have. But I leave it to Kathy to take care of the timer.
We are at the
Bye.
end of our time. If anyone has one or maybe two quick questions, stick them up there and we'll ask. And then, but I think mostly they've asked them as they went along. Oh, good.
I like
So
to do that because
there's-
sometimes I can
y'all
overspeak and not
take
leave
that
time for questions.
QR code there. If you want a virtual cup of coffee, do that. Make sure you get this screen. Once again, make sure you go through the chat to get the referrals that you've asked for in there. And then I don't see any other questions, so I'm gonna say going once. Oh, here comes one. Any books that you recommend on notes?
No, but I'm going to tell you this, not a book. I'm glad you asked that. I was contemplating whether I should put it up here or not. There's a video called Debt as Money that everybody should be watching. If you're interested in buying notes, getting involved in the lending side, Debt as Money. They've done a couple different versions. It's an animated video, but it's very good to give you the history of money, what money is, how it all interplays into society. And that'll give you a good overview and a good understanding as to how our money system works. And I think that's vital because we're all looking to make money, but we need to understand what money is. And there's not a lot of teaching out there, but I was going to put that up on the screen too, actually. But that's a very good, and this book is a good one too, if you want to. Here, I'll recommend this book. This is one of the better ones out there. The Banker's Code. I gotta get in front of my. All right, let me turn my Banker's Code. There you go. By George Antone. That's a very good book too. He's got a couple of books. I recommend. They're easy reading. It'll tell you about. He's got the Wealth Code and the debt. What's it called? The debt something or other. I don't have it there. The Wealth Code. And those go into a lot of the concepts that I talked about. A lot of my training comes from George Antone and a lot of the experiences that I had. So a lot
Pulling
of
them
good
books
stuff.
out of the trees, y'all. How cool is that? All right,
I know.
one question. This is your last question. David says, thank you so much for that. Are there any metrics we should review to identify the cycles? Before he answers, I'm going to just say, I put this in the chat. We won't say it again. So read the chat. If you want the recording of this meeting, it'll be available by tomorrow. Go to the calendar, scroll down to this meeting, and the recording will be there. You can only see it if you actually attended this class, so it's not available to anyone else. Okay. This is last question. Go ahead, Rob.
So that's all subjective as to everybody, where you get your information from, what news feed you're listening to, and what, because honestly, the information is being so manipulated out there today, and it's manipulating our thoughts. So it's a matter of which belief system you come in from. I'll tell you what I read on a daily basis, because it's not so slanted. There is some slant in there, but zerohedge.com takes financial, political, worldwide and local. So I like looking at a broad spectrum of things so I can come to my own conclusions. Some of it is BS. Some of it I don't believe in. Some of it, yes, it goes right along with my beliefs. But, a lot of the information out there can be manipulated. So it's a matter of where you believe. All this investing, there's no guarantees, right? The reason why we can make money is because we take risk. And so making our bets on this part of the cycle, that part of the cycle, it's all a guess. There's no concrete science to it. The reason why we can make money is because we take the risk. Sometimes we lose and sometimes we win. We just got to win more times than we lose. That's all it is. But I like to go to Zero Hedge. I see the information there.